Jack Brennan is co-founder of CIS. He's our founding board chair and overall MVP. As his bio indicates, Jack is or was the chairman of a bunch of stuff, but I can understand if you're confused when you look at the speaker bios and see a picture of a much younger man. So it's my pleasure to hand this program over to Jack Brennan. Jack, thank you.
Thank you for that warm introduction, Tom. That's been our life together over 35 years. I knew him when he was just a cub lawyer. We could have fired him and ruined his career, but here he is now. Yeah, exactly. Thank you. And thank you all. And Drew, your session was a perfect tee up for us, what we want to talk about today. As you've seen, the panel is described as managing long-term portfolios in a short-term world. And, we set this title up a while ago, and then if you just think about the last couple of weeks, most of you never heard of Silicon Valley Bank before 2 weeks ago, right? Most of you have never thought that a run on a bank could be caused by a tweet by a man you'd never heard of. And so it's headline, headline, headline. Markets volatile, up 400, down 500. Interest rates go up 25 basis points. The market tanks, but it was up 400 points last time I looked. And those distractions are not healthy to management of long-term permanent pools of capital. And so, and I know whether you're a professional or whether you're a committee member or you're a beneficiary of one of these large pools of capital, the noise is always about the short term. And that's not how you make great returns to help you accomplish your mission. And that is what my great partner, Scott Malpass, and I started out to do 10 years ago, Scott, hard to imagine, right? And was to try to help institutions get access to world-class money management managed with Catholic values and according to Catholic principles, so that, when we first started talking about it, we'd say if a high school can earn an extra $100,000, it's 5 scholarships, or it's 2 incremental teachers, or it's a whole bunch of things. And that's why we started Catholic Investment Services, to try to bring long-term thinking and world-class money management to a variety of institutions like we have represented in this room. And so we're thrilled today to have 3 great thinkers about investments. And unlike Tom, who had a cheap shot-filled introduction, I'm not even going to introduce them. There they are. Because we would much prefer to hear from them, I think, than about them. Their bios, all kidding aside, are in the paperwork. But we're very fortunate to have 3 very experienced people who know how to think about portfolios from a long-term point of view. And so, Katie, Fran, and Adam are going to share their wisdom with us on a variety of topics, but our fervent objective, and my fervent objective as the moderator, is to keep the conversation up here. And the questions that came from the audience about private equity, and the answers came back, it's a long-term asset class. And one of the advantages that private equity has, it's a long-term asset class, so you didn't run for the hills and do something stupid in the fall of 2008 because you couldn't. You might have wanted to, but you couldn't. And so we're going to try to have that conversation stay at the highest level as we can. We're going to talk about a bunch of topics, and we're going to leave about 10 minutes at the end for questions. So if you have some, we'll hustle around and answer them for you. But the sort of big question, the first question I want to hear from the panel on is, it's hard. It's hard when you have committee members, or you have faculty members, or you have other constituents who read the newspapers, watch TV, God forbid, watch CNBC, which fundamentally makes you stupid. Did I say that or think it?
I heard that, yeah.
It's proven fact, actually. I'm sure he has a chart on that as well that shows IQ points lost per minute for watching CNBC. It's a verifiable fact, I can tell you. But so let me start with you, Katie. How do you you personally, and then you for the institution, the great institution you serve at Loyola, how do you keep focused on winning in the long term when the noise is all about the short term?
Yeah, that is a great question. It's been especially relevant over the last couple of weeks, as you point out, because what my job is supposed to be is saying, how are we earning money for our institution 50 years from now? Except today I'm calling up all of my managers and finding out how much cash they have at Silicon Valley Bank. But you know what, in my career in investing, there's always something. There's always not necessarily a fire, but there in this job, and especially in the CIO job, you do have a lot of constituents. You get random emails from people around the university. And a lot of times, whether it's your managers or something you have to deal with institutionally, there can be a lot of whack-a-mole. You're just trying to tackle things, and you really run the risk of letting the urgent get in the way of the important. And this happened to me a couple of weeks ago, even before Silicon Valley Bank, where we've got transactions happening, we've got research going on. I actually took a couple moments, took about an hour, went in my office, closed the door, and I said, what are the important questions here that is my job to answer? It doesn't matter if this US equity manager bought this position or sold that position. I have a staff to deal with that, but at the very high level, what are the questions that are going to be important to this portfolio? What are the questions that are going to be important to Loyola University, who is getting supported by this portfolio, that I should keep my attention on right now? And let noise be noise, delegate responsibilities to very capable people, and really refocus on what my role is as the CIO. And I came with a couple of things that are, what is the best asset allocation that's going to carry us for the next 5 years, 10 years, 50 years? What are markets telling me right now? Where should we be positioned? So, in the spirit of what you said in the intro, to keep your thoughts up here, that's really my job. And it's really easy to forget that, though, with all the noise.
It is. It's even harder in some ways for some committee members, I suspect, because they're, and Adam, you have lots of clients, and you're one step removed from directly on top of a portfolio for a single institution. Same thing, who are the constituents that you and your team keep focused on when you're trying to think long term and how best to serve their missions and institutional needs?
So, when you think about constituents, we do really try to think about the end beneficiary, so the student at a university, a pensioner, and we try to keep our eyes and our focus on that person, on who we're serving. We've even, the mission statement of our firm includes that. It thinks about, who's the ultimate beneficiary that we're serving. But I think the flip side of that a little bit is, if I think about what do we do, what are the techniques we use to try to keep our eyes on the long term, it's about communication. And so part of it is about really communicating a clear and consistent message over time to the constituents, especially the people who are overseeing any portfolio we manage, so they understand what are we doing and why. And before we even get to that, it's about knowing for ourselves. So it's really having a very clear investment philosophy, a set of beliefs. I'm a real believer in documenting things. I think if you can write down what are we trying to achieve and why? What do we think about? Katie alluded to strategic asset allocation. What is the allocation we've chosen? Why have we made these decisions? Document those for ourselves. And then we're very transparent in explaining to anyone who asks, these are the decisions we've made, these are why we've made them. And it's not going to make us perfect in the face of news flow and headlines, but it gives a very good processing filter, I guess, if you will, for assimilating this news and saying, well, here's how this fits into our objectives, or here's why this is a concern, or here's why we want to address it in a proportional way. And this is something, if it's CNBC, this is just noise, and we can leave it aside. We have to be respectful. If a constituent asks, well, what about this factor? We need to have a response. But I think having that philosophy grounds us and makes us able to give a sympathetic, but also a very clear response.
I think that writing down point is so important. Early in my career, people didn't, it was kind of 5 committee members decided what to do with an endowment portfolio. And you zigged, you zagged, and you end up trailing an index somewhere along the way. It's a great point. Brennan, you've been consulting to investment committees your whole career. And same question. I mean, what are the biggest challenges you see when you're sitting in front of a group who may be worried about the daily when they're really thinking about the decades?
Yeah, for us, I would say it's, I kind of use the two Bs, and we were laughing a little bit about the CNBC, but the first is the business model. And what I mean by the business model, probably 90% of the business model is to get attention, right? So whether it's the internet or financial media. And so the business model is not to make you successful with your investments. As sad as that may seem, you know, a 50-year allocator would be better off to turn off all of that noise, right? So first off, I think you have to understand, if the business model is not your friend, the business model may be your foe, right? A lot of what I do for Vanguard is communication, and I could be saying the same thing today that I said 10 years ago, but it may not get me on CNBC. So I would say pay attention to the business model. The incentives are mostly to trade, to get your attention, to distract you for the short term. The second one, I'll go to another B, is biology. So we've got the business model and biology. Biology is that when you are fearful or stressful, research shows that your time horizon shrinks. It's just a natural biological happening within inside your body. You know, so if you're being chased by
Far heavier than I expected for this group. keep going.
If you're getting chased by a bear, you do not care about the next 30 years, you care about the next 30 seconds. And so fear, loss aversion, pain will make committees make decisions that lose sight that this is a 50-year horizon, maybe it's a 6-month horizon.
It's very interesting.
Can I add one thing to that? I think that's a really important point. One way to try to mitigate against that is to plan ahead and to mentally stress test your portfolio. I think a lot, you know, and it's a really important exercise for any portfolio or almost for any decision, is to think about, you know, it's having humility. How could we be wrong? And in a scenario where we're wrong, what does it look like? And how can I prepare, again, the board, so that if this idea doesn't work, they know this is the kind of backdrop, and they're forewarned is a little bit forearmed. It doesn't reverse the biology, but I think it protects you a little bit from making a bad decision under stress.
It's actually a relevant point. It's what a couple of the large banks that had problems didn't do, apparently. They didn't stress test, and it really is a great tool. Do you guys go through that exercise of saying what ifs, Katie, at Loyola?
Yeah, we do. You know, once a year we review our strategic asset allocation. I wouldn't say we make a lot of major changes. It should be a long-term asset allocation, but I think it's useful to re-underwrite that periodically. And one of the things that we do go through is a stress test, and we have some software that allows us to do a scenario analysis. What if 08 happened? You know, what if oil goes to 150? What if, you know, somebody attacks somebody else? You know, just a lot of position level, quantifiable analysis that we could do. The next crisis is not going to look like a previous crisis, we know that, but at least it gives you a sense of, given this portfolio, where it's positioned, how much risk we have, how asset classes work together in correlations. If we experience an event to the magnitude of X, this is what we can expect the portfolio to produce. And so then when we work with the committee to, you know, re-underwrite this asset allocation, you know, it's helpful to say, given the portfolio positioning now, this is what we expect to achieve, but here's the risk that we could be facing. Are we okay with that? You know, if this event happens, are we tanked? You know, can we meet our draw? Are we in full-on panic mode, or can we withstand that? And I think really quantifying the downside as best as you can as far as a, you know, possible worst-case scenario is helpful, because if something happens, you get a big drawdown, panic doesn't set in because we know that, you know, this is within the distribution of expectations.
It's actually a great point. And so I wanted to ask, Fran, I'll pick on you this time. Absolute or relative in terms of thinking about your own, the expectations? How should we be thinking about it? You get, I think one of the worst things that's happened in university endowment management is Harvard and Yale competing with each other on an annual basis. It's just silly. They're 300-year-old institutions with 300 more to go. And so you end up in, it feels like mutual fund performance derbies now. Do you advise people to do absolute in terms of, maybe it's against an index, but not against peers. How do you think about that? If a committee wants to talk to you about stress testing and testing, is it against your own balance sheet and income statement, or what's the best advice on the thinking long term?
Yeah, I think, again, it's very hard for the average committee who maybe be advised by a consultant that are pushing relative, the performance derby. How are you doing relative to your peers? But in all honesty, your peers don't matter to all the points that you were talking about. You may have different goals, objectives for the money, and what the return of Harvard or Yale or Notre Dame is doing relative to your own endowment or foundation could be entirely different, as well as the asset allocation could be entirely different. So I think, as hard as it is, again, to push against the business model where a lot of the consultant community may be pushing you into a relative, you have to take ownership of the portfolio and the fiduciaries and the beneficiaries that you are serving, and make sure that they are the end constituent that you're serving.
I would just add, I think, again, very much linked to that idea, is pre-planning. Think about it ahead of time. If you know, as a chief investment officer, as a board, how you're different than peers, then you can plan for an environment where things are going to look different. If you have a larger allocation to private equity, then in a period when private equity is outpacing public markets, maybe that's every year, but in a period when it's outpacing public markets.
You believe that, Richie? Believe that sales pitch? Isn't that the business model thing? What are you talking about?
If you, whatever direction, whatever tilt you have in the portfolio relative to your peers, if you own that and you know it and you understand why you made that decision, then you're prepared for, in a period where you lag, well, this is it. We had a reason. We had a philosophy. We decided on this approach. We knew ahead of time. Ideally, you think about it ahead of time. Again, it comes back to that stress testing idea, when we're going to outperform and underperform. And I'd add one more thing, and I think we as an industry can probably do better on this, but even down to the manager level, right? If the boards maybe shouldn't always be in the business of choosing managers, but when they are, so that you avoid firing a manager at the wrong period of time, ask the manager. They should be telling you anyway, but ask them, when are you going to struggle? When are we going to have a difficult period of performance? And again, know that ahead of time so that if it plays out, you're hopefully not losing faith. Maybe your faith is confidence in them is actually increased.
This head is nodding. I think experientially in some ways, Katie. You agree with what those guys are saying?
Yeah, oh, absolutely. A couple things, one to the point about, peer benchmarking. In an ideal world, you wouldn't care what your peer institutions do because you don't have their budget. They don't have your specific needs, and you should be investing on behalf of what's best for your institution. And that's a perfect world, but it's not the world we live in because, we get ranked. Cambridge puts out everybody, NACUBO, publishes everybody's return, and everybody wants to know how are we doing relative. So I do that. I show our committee, how are we doing relative to peers? But to the point about asset allocation, and especially in the last several years, it has been a big driver of return. How much did you have in privates? How much did you have in venture? Have almost been the only thing that mattered as far as performance. And so as an institution like ours, who is building our private markets portfolio, really had maybe 2% in venture versus somebody who had maybe 13 in years like 2020 and 2021, well, we don't look the same. We don't look the same at all. So let's benchmark ourselves against institutions that are the same size, similar asset allocation, and then let's take a look and see how we're doing, because then you're really comparing apples and apples. And then to the point about manager selection, it is a really, a lot of an art in addition to a science. There's, at the point where a committee who doesn't look at it every day, who doesn't analyze performance with the same nuance that a consultant or an internal team might do, if you have confidence in that manager, when they're underperforming, a lot of times that's when you want to be adding to that manager, not firing them. Conversely, I am probably going to terminate a relationship after a period of spectacular performance. Their style was in favor, we rode that, but this isn't a good long-term relationship. And so you have to explain to your committee, why are you going to pull the plug on a manager who's just outperformed their benchmark recently if you're just looking at the trailing returns? So to the question, should committees pick managers. I think it just really depends on how well you understand what you own.
It's tough, though. It's a hard job. It's a hard job to do, and the tendency, the biological tendency is, if you look at the best data is in the mutual fund industry, and the dollar-weighted returns are far less than the time-weighted returns, because all the money goes in at the top and comes out at the bottom, because it's hard to fire the good performer and hire the one that's underperforming for the retail investor, but it's just as hard institutionally in many ways.
I think with committees too, the group dynamics can get in the way. I haven't really seen this documented. I'm not sure that someone's done it scientifically, but I think when you have a committee meeting, if one person is risk averse at the wrong moment in time, they can sort of pull the rest of the group into them, because people have the best intentions for the organization, but in a moment in time where maybe the world is in some panic, and as we've said historically, that's not a good time to be pulling back. But if someone's saying, well, I'm really nervous, it's easy to sort of create a little bit of velocity around that you don't want. So I think you really want to be aware of the group dynamic within a committee and try to, again, Katie's got a difficult job in that regard, but try to manage that and help your committee understand that, again, a lot of this is about self-awareness and having, hopefully the investment team is self-aware, your managers are self-aware, but I think committees too should be self-aware about what they know and what they don't.
It's funny, that the old "I didn't appreciate experience till I got some" is a very real thing in investing, in particular. At least when I was in my 20s, oh, who needs these guys? And suddenly you realize, having been through it, gives you some sense of ability to be calm. Last question around this. You guys are doing a great job, by the way, of staying on strategic and focus. I appreciate it with the panel name. But the new thing is always coming at you. Or coming at your committee and they bring it to you, and why aren't we doing this or that? One of the great new acronyms of the last few years is FOMO, right? Fear of missing out. And one of the shocking things has been to see who were late arrivals to the Bitcoin world, and really great firms, and got bitten really badly by it. Adam, how do you avoid either it's FOMO or getting sucked into the new thing, or the noise again that comes from this or that being really attractive, at least in the public sphere, but not fundamentally sound?
So I think it comes back to your point about experience. I think you want to have experienced hands. That's why you want diversity within a board. So you want people who have lived through some of this and who have have been road tested and have seen some of the bright new things come and go. I think approaching something that's really novel you can be open-minded, but you want to have a little bit of a skeptical bent, especially where the more there are promises of this is going to revolutionize something, this is really going to change things. Really, think about the risks, think about what's unstated, and also just think about the motivations and the economics for the people who are behind it and pushing it. And that's not a perfect answer, but I think that will filter it. I want to be careful because you don't want to be too negative. There is room for innovation. The classic example in my mind is TIPS, Treasury Inflation Protected Securities, right? Those came out in the late 1990s, a novel instrument, never existed before in the US, was sort of untested. In hindsight, and some of this might have just been a historical accident of when they came out, but if you invested in those when they came out, you locked in a pretty compelling real return.
It was a good deal for the investor, yes. Bad deal for the taxpayer.
That's right. but so you don't want to rule out something just because it's new. You want to apply a filter, but I would apply you want to have a very high bar for new and the more they promise and the more they sort of underplay the risks, the more hesitant I would be.
Fran, when you're visiting committees, you're peppered with questions about this or that. Same kind of answer, experience, skepticism. How do you go at it?
Yeah, I think experience is critical. I also think if you maybe do a pro forma out 3, 5, 10 years of what would have to be true for this actually to make a reasonable investment today. Many people are familiar with the Cisco story in the late 90s and what their PE ratios were. And if you actually went out 5 or 10 years, if they would have even had a return or growth like the market, they would have ended up being 30% of the market, right? So, whether you take Bitcoin or whatever's out there, cryptocurrency, blockchain, you have to say to yourself, what things would have to be true to make this actually come to fruition in 3, 5, 10 years and underwrite it in the future? And I don't think enough people do that. They don't actually take the steps to underwrite what would have to happen for this to be true 3, 5, 10 years out, and then what would that actually look like. And if you actually start with the 5-year, 10-year in mind and get back to the present, I think you'd find that most of this is speculation.
So let me, I want to just wrap the highest level, and we'll get down to kind of real stuff, like what do you do in a minute. But so we were here 2 years ago, and I said, can you get a real return plus 5% on your portfolio? So you get a 5% draw and keep your purchasing power. You get a mixed set of answers, but the environment's changed. We have higher rates, but we also have higher inflation. So I'm going to, each of you guys, and I'll decide who, I'm going to pick on you first, Fran. I've known you longer. So you get a chance to work up your answer. 10 years. How hard is it going to be to earn a real return after a 5% draw on an endowed portfolio?
I think it's going to be incredibly hard, and you don't even have to look 10 years out. I was looking on the way here. The 10-year, 15-year, 20-year, 25-year are all below 7, and closer to 5, then 7 nominal. And if you take 2 to 3 off,
I mean forecast returns or trailing
return,
yeah,
the trailing returns 10, 15, 20, 25 have been closer to 6, and this is nominal with 2 or 3 inflation. Going forward, even if inflation settles, let's say the Fed is 2 to 3% target, it's going to be 8%. Even though yields have come up, the yield on the 10-year Treasury is still 3.5%, right? So it's off of 0. It's going to take a lot of Hamilton Lane and private equity, to kind of get those type returns. But public equity markets, should be able to get you 5 to 6 over. But if conservative investments are getting you somewhere around 1 over, and then it's just going to be hard to do that. So for those who actually have the flexibility not to have a 5% spend, because some of it's mandated through tax law, but those who have some flexibility should really consider having that conversation.
Adam, what's your guess?
I'm sympathetic. I'm probably modestly more optimistic than Fran, in some ways actually because of the historical data. The fact that it's been challenging for the last 10 and 20 years, I think maybe from a valuation perspective, it actually looks a little bit better prospectively. But the big challenge in my mind is, I think you stated a big if, right? If the Fed gets the inflation rate back to 2 to 3, I think the inflation rate is going to come down, but I'm worried we could be more in the 3 to 4, maybe even a little higher range over a decade. That's going to be the real challenge. I think it's a little bit on central banks. They may make our job harder in this period.
Katie?
Yeah. I guess I'd be right in the middle of these guys. I am a little more optimistic than Fran, maybe not quite as much as Adam. I think we're starting.
When Fran was younger, he was much more optimistic. He was much more fun to be around.
This time last year, at our March committee meeting, when we go through asset allocation, I had a big slide, and the title wasn't "uh-oh," but it was something close to that, because you could expect, given where valuations were, given where bond yields were, a 60-40 portfolio might earn you 4% nominal. I mean, it was really bad, and we talked as a committee, like, what are we going to do? This is our spend, So fast forward a year, valuations have corrected. The bad news is we lost money. The good news is things are priced a little more attractively. Our starting point is a little higher. Bond yields, which is kind of the base for asset prices, are higher, so we're starting at a higher base. I think equities haven't corrected probably enough, but the forward-looking return now is better than it was a year ago. I think as we look at, we still have to own equities. That's a return driver, and I do agree with what was said about if you can reduce your spend, that's probably the best. We're in a good position. We budget for 4%. Historically, we've spent less than that. I think we'll be spending a full 4 going forward, but if any, even 1 percentage point that we don't have to spend helps the long-term appreciation of the pool. Within our asset allocation, though, one of the things we're looking at is, how are we going to still generate that? And I think a lot of that means that we're going to try to lean into places where risk premiums are higher. In the U.S., I don't think equities have corrected enough. Bond yields have risen, so the risk premium that we're getting still isn't great. But it is it's a lot more elevated in other developed markets and in emerging markets. Of course, it all comes with a different set of risks. But, together with hopefully alpha we're getting from hedge funds, hopefully with long-term performance we're getting from our privates, I think we could get there.
To 5, not 4.
Yes.
Yeah, good. That's encouraging.
I just want to add one comment. Sure. Jack made us promise no slides, so I don't have the numbers right off the top of my head. But I have been using this slide. It's really amazing to me the impact that 2022, just a single year, had on trailing 10-year returns. So again, I'm doing this roughly from memory, but I think at the end of 2021, a 70-30 stock bond portfolio on a 10-year basis had earned 7.8, like roughly 8%. 1 year, roll the clock 1 year forward, that 10-year trailing return, not a 1 year, 10-year trailing return had come down 2-ish%. So it's a very different backdrop.
So one big takeaway from this, I hope for the audience, is the idea there's the returns and then there's the spend. And if you have flexibility from this point in time, it's always good to draw less if you can do it, if you can afford it and budget it. It's that's where some really high-profile institutions in the financial crisis and got over their skis. They were drawing 50% of their budget from the endowment, and the endowment's down 25, even though the others are down 30. But they ended up having to borrow money to pay the bills, and so and it's no different if it's your IRA and you're in retirement. It's the same strategy. So let's talk now about sort of key long-term strategy topics. Okay. You mentioned the 70-30 portfolio. I don't know how many times we've seen in the last 12 months, 60-40 portfolio, which is kind of the retail number, is dead. Is it, Adam?
All right, I get to go first. So I think the answer is no.
Tipping
It's
you
fine.
off.
This
I'm
is
keeping you on your toes. I don't need anybody to go to sleep on us up here. So
no, I don't think so. I think it needs a little bit of tweaking if you're going to keep it current. And it's funny. This is definitely an issue right at the top of my mind right now. So you think about what's happened. I think part of what's made it more viable is what's happened in the bond markets, right? For the last 10 years, the prospective yield on fixed income was just so uncompelling, it really made the math of 60-40 quite challenging. As Fran said, it's back. It's not maybe all the way to where we'd like it to be, but it is not the same drag that it was historically. The really interesting thing to me, though, is even as our expectations for fixed income for bonds have come up in terms of returns, we're a little bit concerned they may not be the diversifier that they were in the past. For the past 2 decades, any time the stock market sold off in a meaningful way, bonds rallied, not enough to offset your losses, but enough to curtail them and give you a real diversification benefit. If inflation is going to be in the backdrop for the next 10 years, I don't think we can't bank on that diversification. It might come in some scenarios, but we're really thinking that a 60-40 portfolio probably needs allocation to other diversifying strategies beyond just fixed income. So I think to me, that's the crux of it. And then I think the other piece is consistent with sort of where we started. I think we're in for a more volatile 10 years than the ones we've just been through. So I think thinking about other ways to stabilize an equity portfolio and try to reduce the left tail risk, again, I think works to the portfolio's advantage. So I think 60-40 can work. It just needs a little tweaking.
the 40 is a different mix at some level along the way. You agree, Fran?
Yeah, I agree with everything Adam said. I used to cringe when I always heard that bonds are the ballast for all the points you mentioned, but it's really been a 40-year decline in interest rates. What missed is...
Actually, 700 if you go back to British. There's a great chart, the British gilts. It's a 700-year bull market in interest rates. I was around at the beginning of it, not these guys, but...
I can only remember from the 60s on, so... But I think what we're talking about is bonds being a good diversifier. It's largely been in equity contagion, right? So when equities have sold off, bonds have done well. But what that research doesn't show is when equities are doing poorly because interest rates are rising and inflation is rising. So if you look at those same analysis in the 60s and the 70s and the 80s, bonds were not a good diversifier to equities. So I would agree with Adam. Diversification still works, but the 60-40 of maybe just a 2 asset class portfolio of U.S. stocks and U.S. bonds are quite dependent on a regime of year-over-year decline in interest rates and year-over-year decline in inflation. If we are in a period where that is not the case, adding more diversifying strategies to that portfolio might make sense.
So what do you do with diversifying strategies, Katie, in your portfolio? You already mentioned global. You're interested. I want to come back to that. Actually, let me ask you about global just to start with. I did some numbers this morning. So over 10 years, a diversified global portfolio trails the S&P by 700 basis points. Doesn't seem like it's worth the hassle. Yeah, over 25 years, it's 400 basis points behind.
Yeah.
I'm being provocative. I don't happen to agree with that. But how do you think about getting that? You know, when you look at endowments have done really well because they've been broadly diversified over the years. How do you think beyond stocks and bonds, if you will?
Beyond
U.S. stocks and bonds.
U.S. stocks and bonds, okay. Well, a couple of things I'd say is, you know, the last several years, the outperformance of the U.S. over anything else has been dramatic. So I think that is responsible, you know, in a relatively short period of time, has been responsible for a lot of the performance of a long term. You know, you don't have to go too far back to find years, you know, kind of in the early to mid 00s where, you know, ex-US did better than US. You know, so it does go in cycles. I think, you know, capital movements, you know, valuations, dynamic economies, they all play into that. I'm still a big believer in global, you know, especially right now where I think valuations you know, we do have a lot of strong companies in the US that's unquestionable. The valuations you're paying for them don't suggest a very attractive long-term return. Whereas I think you can see, you know, in other countries, you know, and especially in emerging markets where the valuations are a lot more compelling. You do need to navigate, you know, and this is a strong case for active management, especially in emerging markets, but you can still find companies that are growing, are trading at reasonable multiples, and are located in economies with big growth drivers. So I do think that even in global equity, diversification still pays off. I don't know if you want to move on to diversifying strategies like hedge funds.
Yeah.
One of the themes that we have in our investment office for the next 10 years is kind of undoing of a lot of what happened over the last 10 years. So I think dispersion is going to increase. So that the theme of increased dispersion, I think, is leading us in a couple of directions. I am more of a believer right now in hedge funds and hedge strategies than I've been in the past. And we've done it in the past. But, you know, in a market where everything is like up and to the right, you don't need a hedge fund. I mean, just put it in the index and walk away.
No, this is a drag on returns, right?
I know, it's just, yeah, it's not been helpful. Put it in the index and walk away. But I think that is no longer going to be the case. I think that there is, you know, the correlation between stocks and the index is a lot lower. I think you're going to see a lot more dispersion between performance of good companies and bad companies. And I really think it's going to be a stock picking environment over the next 10 years that has not been the case necessarily over the previous 10 years. So we're going more towards active management. We're going more into hedge funds, and we're looking at strategies that will benefit from dispersion. You know, we've just added a global macro fund to our lineup. Macro kind of had a bad month, but not our fund. We're okay still. But, you know, I think that, you know, as you see policies start to diverge, central banks start to diverge, FX starting to do things as we deglobalize, policy changes, inflation is different in different countries. There's going to be a lot more opportunity for alpha between different countries, between different asset classes, between currencies, between interest rates that a skilled manager can pick up on and add diversification that way because it's not dependent on a direction of capital markets. And, you know, and same with long short. You can identify businesses that are going to win. You can short businesses that are not going to win. So I think the time is really, really right for those kind of strategies.
It sounds like what you guys are going to do with Catholic Endowment Fund.
Very much. So we had a pre-meeting to discuss the panel, and we said Katie was going to answer these questions, and we would have nothing to add. And she really, I mean, that was we're thinking about the future in exactly the same way. I would just add one factoid because it's on my mind. I was just researching it over the last week. Not exactly the U.S., non-U.S., but developed versus emerging, where again, we see a lot of skepticism from some of the boards and investors we talk about. Emerging markets have been really disappointing to a lot of investors over the last decade. But I went back and, since the late 80s, they've outperformed by a really wide margin. And if you look under the hood, lo and behold, decade by decade, 10-year period, so you do the 90s, the 2000s, 2010s through 2020, it flip-flops. So you have a decade when emerging markets outperform and a decade when they underperform, except when they outperform by high single digits, and when they underperform by low single digits. So I think it's easy to give up on some of these asset classes after, 10 years is a long time to underperform, and it's easy for a committee to ask those questions. But I think, to Katie's point, diversification really does still work. And I think we've come out of a really unusual decade where all the things we were taught to do around diversification didn't really contribute much.
It's a great reaffirmation of a long-time set of data points. Fran, the other one is what we heard from in the terrific luncheon talk was private equity. You were a skeptic in your youth and have become a big fan in middle age. Are you middle-aged?
Yeah, beyond middle-aged.
So two questions. Hypothetically, the role, the size of a position, we got an answer on clients from Hamilton Lane, but how do you think about it? And then how do you think about the liquidity?
Yeah, so was a skeptic, and mostly around what was shown on some of the slides, really around access, right? So the question of what institution has access to the top managers, because all of the research shows if you cannot access the top quartile managers, the asset class is probably an asset class that's going to be challenged because of the high costs and everything we heard. So you have to believe that you have either the ability or the skill or the size and the due diligence, or work with a partner that's going to get you top access. And if those things are true, we at least at Vanguard, we went into the private equity space 3 years ago. As far as allocation and illiquidity, we do still see it, and I think some of the charts you saw there of correlation, we see it as part of the equity high risk on sleeve. And for our investors, we think of that as 20 to 30% of the equity. So hypothetically, if you're 70-30 equity, if the 70 is equity, 14 of that to 21 of that would be private, the rest would be public. And then the last step would be, just making sure that you can withstand the illiquidity. The most important thing there is making sure that you do not have an investment policy that binds you, because the allocations are going to drift and drift quite widely. So what we saw in 2008 is that because private equity didn't mark, public equities did. And if you had a policy portfolio that said you could only have X amount in illiquid privates, you would end up being in violation of the policy. So you have to, a couple things, make sure that the policy is written as such that the guardrails are quite wide. Understand you'll probably never get to your upper bound because of how long it takes to actually fund private equity and then the cash coming back. And then make sure that you're comfortable with the illiquidity, because to try to sell it in distress, if you can even find a counterparty to sell it, will be quite challenging.
Helpful. It's actually a great reaffirmation of the strategic tenets, right? Come back to the original point, long term. We're going to take questions from the audience if we have some. I got plenty more to talk about here, but we have microphones in the back. We have one here. Is there a second person? Do we have more than one? Because we want to be efficient. If we have more questions, raise your hand and we'll get you a mic as well.
Hi, thanks guys very much. Jack, one of the things we didn't talk about, except Fran at the very end, was liquidity and illiquidity. So one of the great lessons, I think, from the financial crisis for endowments was they were too illiquid or they didn't have the right balance. And we saw many having to take loans, a lot of stress in portfolios. A lot of push today about alternatives, illiquids, grabbing that illiquidity premium, et cetera, et cetera. Maybe for the panel, how do you think about balancing liquidity in your portfolio in today's environment?
You do it
Let
every
me,
day.
let me ask you, and how do you measure and report on it? Okay, because it's an important thing to
How
know
do we
in
measure
advance.
and report? Okay.
Yeah.
Yeah, I mean, that's a question that's, I mean, especially at Loyola, is getting a lot more relevant as we're probably looking at increasing the endowment draw. You know, I think about our asset allocation as role in the portfolio, you know, growth, diversification, and liquidity. And our fixed income portfolio right now is very liquid, and there's sufficient enough liquidity to, you know, if you do a stress test, you know, if markets drop 20, 50%, can I meet my capital calls? Can I make my distributions? How many years of spend am I covered with what I can sell right now without, you know, selling equity or permanent loss of capital? So that's an exercise that I go through. You know, it's ever evolving, ever changing, but, you know, also within our private equity, you know, we have some software where, you know, we can shock our private equity system too, to say, what if, you know, we go through a period of time and our managers aren't making distributions, because we're counting on, you know, we put out capital calls to make investments, but we're, you know, the model works when they're sending us back distributions to help fund the capital calls and help fund our spend. Well, in a time of crisis, you know, distributions fall off the cliff. And so you need to make sure that when you look at your whole cash model, you know, not only you need to be able to make sure you can get your liquidity from fixed income, but you need to understand that the distributions you're getting from private equity are probably going to take a haircut, you know, so I shock it by 70% or something like that. So I think in that framework, making sure that you can get liquidity when you need it without selling in distress is probably one of the top jobs, especially in an environment like this.
Actually, I just wrote a note on this, very similar to what Katie described. I think it, obviously, if you have more sophisticated software, that's even more powerful. But you really, even just in a simple Excel spreadsheet, you could do it on a piece of note paper. What are your sources of liquidity? What are your uses and potential needs? And then you try to stress both of those. So what if the assets I have don't prove to be as liquid as I thought? What if I'm not getting distributions back? Maybe in a downturn, my private equity commitments actually get called sooner because managers see lots of opportunities and I'm actually getting more capital calls. You want to worry about, again, in the context of an endowment, I think it's unlikely that'd be a moment when there'd be a huge draw for, say, a new building, but maybe the budget of the organization's under stress. So you want to, even if you have a 5% spend, does that become 8? Does that become 10? You put all that together and make sure that under those conditions, you're still able to maintain a diversified portfolio, you're still able to rebalance as you need to, that you don't have your public assets shrink too much as a percent of the overall portfolio. That's the test that I'd be doing to just make sure that everything's in line. And if you need to, maybe you have a little bit of a strategy where if we had to scrounge, you know, where would we be looking for liquidity first? So I think every organization should do that. And it really is separate from almost any other risk management that you do. A lot of times in risk management, you're thinking about currency risk or market risk. Maybe you're using currency hedging. That's actually potentially, even though it's taking a risk off the table, it may be adding liquidity risk. We saw that in the UK this summer with the whole LDI crisis. These were organizations that were very thoughtful and prudent about trying to manage their asset liability risk. They just didn't realize that in doing that, they were taking on liquidity. So I think you want to almost put liquidity in a separate box and stress test it there.
But it's part of why you haircut what an efficient frontier might say your allocation to privates.
Yes.
And Drew said that. Once he acknowledged Wellington was in the room, he, but it's practically correct. Other questions?
We talked a minute ago about bonds, for example, maybe not being the diversifier or stabilizer going forward that we've thought about in the past. And we have to mark them to market. But if your strategy is to hold to maturity, does it offset that?
I don't think Silicon Valley Bank would say it does. And that's the problem, is if your strategy is but the reality is, can you? And so you almost, I would argue, you have to keep 2 sets of books. You have to keep them, in insurance, there may be people in the insurance, there's statutory accounting and there's GAAP accounting, and they're different. But to ever assume it's a permanent asset and be comforted by that, I think is probably, history would say, that's not the way to most prudently manage your risk.
There's another practical element to it as well, which is the need to rebalance. So if the idea of having a diversified portfolio, if equities sell off, you actually then want to be selling your bonds to buy equities. So you can't really guarantee you're going to hold to maturity. You might have to sell as part of the rebalancing process.
Yeah, and I would just add one thing. We get this all the time on individual bonds, laddered versus bond funds. It is just a mental accounting that you're just not marking to market the true value of the bond. You're carrying it on book value, but the real value of the bond's less because interest rates went up. You're holding a bond that may have a 2% coupon when the market's now 3.5. So you didn't mentally on the balance sheet mark to market the bond. But you could easily sell that bond today and reinvest it at 3.5%. So I think it's more to Jack's point of carrying 2 books.
But the GAAP book is the one that's the real book. Because, it's a little bit, when you talk to people in the venture business, they say, get all the money you can while you can. Because when you need the money, you're not going to be able to get it. It's why Warren Buffett is the bank for distressed enterprises, right? He has all the cash, and he's not paying you book. He's going to pay you market for those assets, and that's why he's produced such outstanding compound returns over time. He has the liquidity. One last question, if there is one. We're bumping up against our time. Over here.
Thank you very much. Question about what Katie was saying on maybe heading into more of a stock picking environment over the next 10 years. I was just curious with direct indexing and Vanguard acquiring a small direct indexing company, is this a fad? Is this something that could help endowments get exposure to a broad base of equities, or is this kind of more active, getting into active management? I'm also curious with the kind of faith-consistent investing screens, if that could be an attractive part of direct indexing where you're trying to own, the underlying components of the index itself.
Fran and I have talked about this. It's a very interesting question. Go ahead, smarter man than me.
No, I think you're spot on, right? To try to just maybe take a step back in case people don't know what direct indexing is. So you can buy the S&P 500, which would be all 500 securities. You could buy the total world, which is all public securities in the world. Direct indexing allows each individual to create their own index. So it really does bring the best of both worlds, broad diversification, low cost, but then you could do a couple different things with that. It does 2 main things. It will generate tremendous tax loss harvesting because the dispersion of the individual stocks are much greater than the basket of stocks. We saw that 40% of stocks are down, but a basket of stocks is not. Why that can help you is not maybe for this audience, but family offices and others can really use that to use active management to offset the capital gains. But the second real use case is to put your own personal preferences into the portfolio. And so your endowment and foundation may have a different set of preferences than the table over here, and it allows you to customize your preferences in screens, because to buy an ESG off the box or just buy an ESG that's screened by somebody else probably doesn't help too many people. This allows you to customize with your committee the exact companies that you want in, the exact companies that you want out. And so we do think it's going to be not a fad, but something that's going to be quite enduring as institutions and family offices try to either manage the taxes or manage the preferences and values within their portfolio.
So we are up against it. I hope you enjoyed this as much as I did, and please a round of applause for these very Katie, Adam, and Fran. Thank you guys very, very much.